everybody. We are back. Market Mavericks is back in action here. How are you guys doing today?
Great.
Garrett, hello.
Yeah. Hey. So, without further delay, let's get right into it because we got a lot to cover. There's been a couple hiatus weeks here, and markets are in free fall. Pretty much every market out there. Scott, what are you seeing in the crypto markets?
Obviously, it's a down day. I mean, you could take a look at coin market cap here if you bring up the screen. Bitcoin down 5.46% in 24 hours. But still, what I find notable is as bad as it is today, if you look at a week, everything's almost flat, right? I mean, Ethereum is down 0.85%. Bitcoin now down 2.5% from a week ago. I think we had that big move up from the low 50s to 70. So to me, this is somewhat of a normal correction. And it was already correcting before the sort of slaughter of other markets today. So I don't think anything so particularly surprising right now. To me, this just remains the boring, choppy summer doldrums of Bitcoin and crypto trading going into August, which is the worst month for crypto and every other market almost every year. I mean, we had signals this was topping right at the bottom. We had oversold bullish divergence, my favorite signal, obviously, with RSI. Then it came up here and we had bearish divergence a couple days ago, and here we go down. But listen, I mean, we're just trading in the 60s right now. It doesn't really alarm me to any great degree. And I think there's definitely an aspect of selling the news after such an epic conference this last weekend.
Yeah, that's what I was going to ask you is was there definitely a run up because Trump was going to be speaking, everyone was buying, hoping he was going to say these things, and now it's after and we know what he said, but it's not that exciting anymore. And you think some of that's part of the selling?
I think that's fair because it was leaked in a week in advance that he was going to say Bitcoin would be added to the strategic reserve. He actually came up short of saying that. He said it would be a strategic stockpile, and he did not allude to buying any more Bitcoin. He just said we'll hold what we already have, which the government's already selling in advance of him even having a chance to be president. So we'll see what that means. But Lummis did come out and introduce an actual bill, the strategic reserve bill. Actually, I probably have it pulled up here from an earlier stream, which talks about buying 1 million Bitcoin in 5 years, 200,000 a year, and holding it for 20 years. Now, do I think that gets passed? Absolutely not. But the very fact that we can see something like this on the docket now, I think is meaningful, and it has to at least have other governments scratching their heads and thinking about doing something similar if the United States has a chance of doing it. But like you said, I mean, it couldn't get any better than it was over the last few weeks. Honestly, his speech was so rambling and boring and nonsensical, and nothing against Trump or anybody in there. It was a Trump speech that had some great teleprompter moments on crypto, but he made it abundantly clear that this is a political, hot potato for him. Raised $21 million at the conference, if you want to know the real story. I mean, absolutely incredible amount.
That's big money, man. What do you think about so we're seeing the altcoins. There's a lot of altcoins that are trading near 52-week lows, multi-year lows. Is there kind of this switch away? Would you consider altcoins to be like really risky assets like small caps and mid caps, and people are getting more risk adverse, and that's why Bitcoin's holding up, Ethereum's holding up, but those are not?
Toxic waste right now, man. That doesn't mean that there won't be a bottom or that when you start calling them toxic waste, they might be near bottom. But the fact is, I mean, I think there's $900 million in altcoin unlocks from previous cycles just this month alone. And most people who have created new tokens and projects have been delaying because of the market to launch them, which means if we get a hint of bullishness in the fall that people are expecting, you're going to have just billions of dollars worth of tokens hitting the market. And it's going to take a massive, massive wave of new retail FOMO to buy up any of that. So I think in the altcoin market now, most things from last cycle are never returning. They might get their bounces. Some new things will do well, I'm sure, but you're going to have to be exceptionally selective. And I doubt the old close your eyes and throw a dart and make 100x thing is going to be happening again anytime soon.
Crazy. All right. So, Mike, talk to us about the stock market falling sharply today. Yesterday, we had the biggest rally since, what was it, in 5 months on the S&P 500. NASDAQ was almost up 3%. Today, we're right back down to those lows. What's killing the markets here? Why can't we hold a gain?
I got to let me show a few charts. It's just the simple facts of the most powerful force in markets is mean reversion. What I show you in white is that's just Bitcoin divided by its 100-week moving average. It's been telling us there's a problem in all risk assets for a while. It's tilting lower. And then the bottom line is just look at S&P 500 versus this 100-week moving average. It's way stretched. It just needs a little spark for reversion. Oftentimes it doesn't need a spark. It just gets too high. The bottom line, as we talked about pre-show, is volatility. VIX volatility index is just starting to recover. That's what I show you here is 52-week moving average of VIX minus the T-bill rate. This is a key thing that helped me make a lot of money in 2008 when I was trading on my own. It's just starting to bottom. It's not even close. There's so much more room here. And then I overlooked Bitcoin with the S&P 500. Key thing I've been pointing out for a while, I'm really concerned about Bitcoin's just showing there's a problem. And then looking at more shorter term, the weekly trade is, so on the S&P 500 E-mini, people on the show have seen me show this before. We've had gaps. There's still that gap back from last year in December. And then we had another one that we filled finally. Plenty of room to just go back and fill gaps and mean revert. I don't see what stops it. And a good indication is Bitcoin versus gold. It's heading lower. But I want to just show you one thing. I think it's the big trade for the next, not couple months, next couple of years. And that is bond yields. Bond yields are just starting to roll over. And that's what I show you here. This is the 200-day moving average of the U.S. 10-year note yield. It's just early starting to roll over. Look at that reversion room. There's so much room. What's a good indicator for it? China 10-year note yield is at 2.13%. Typically, its history is it trades at a much higher yield than U.S. I think U.S. yields are going that way. And then I look at the Bloomberg Commodity Index. It's just getting started. So I'll end with some of the things from commodities. I just published my outlook. And then the outlook from commodities is pretty severe deflation in recession, just starting to kick in. One of those indications is the Bloomberg Commodity Index was at its peak was up 12% in 1H. Now it's flat and it's actually down. Industrial metals, if you think of China and the rest of the world, the Bloomberg Industrial Metals Index was up 24%. Now it's down. And copper is just starting to roll over. I think, I'm sorry, I just want to end with this one. I'm going to be publishing this tomorrow. This is 200-day moving averages of copper. It's still pointing up, and it just dropped below that level today. The 200-day moving average on crude oil. Oh, it's copper's rising. It's just starting to go down, and crude oil is going down, and it's trading below. Everything is tilting downward, and I overlay this with a good reason for them to go lower. Number one is mean reversion. Commodities always go down because they went up, and China is basically heading towards a pretty severe potential depression if you look at their bond yields.
Can you explain to people why? So 6 months ago, if yields went down, the markets ripped higher. Today, yields are falling sharply and the markets are cratering. Can you kind of explain to people why that's the case?
Irrational exuberance. Markets can remain rational longer than we can remain solvent. And I've been waiting for this for a long time, for markets to tilt back to what's normal. For recession, remember that pendulum that swung way too far towards no recession, starting to swing back. And it's classic. Scott talked about this a lot. We've mentioned this before too. And that's the Fed's going to start easing, but they're not going to start easing until September 18. And you look at one thing I want to show you here, economic surprises. Like today, the ISM number has been weak. The economic surprise index in the U.S. is the lowest since right around 2015. I mean, it's almost a 10-year low. So it's typically what I think it's classic human nature, that you never really pick the top, and I think this is the end of one of the biggest bull markets in history. Yes, I'm going out on a limb to say that, but the indications are there, especially when you have volatility really low. But it's that sense that markets are very forward-looking. They were looking forward to that Fed ease. The Fed fund futures first started pricing for 100 basis points of ease in Q1 2023. And the Fed still hiked 100 basis points. Now, obviously, we're priced for much more. We know they're going to start, but it's so delayed now, and it's with the rest of the world going down. And the key reason I like to point out is this is one of the main things that I'm really concerned about. It's what's worked in history. Maybe it's changed, and that's just our stock market's 2 times GDP. In history, its average been a while around 1. I just show it using the S&P 500. Last 30 years, take the S&P 500 divided by GDP in trillions, just add 2 zeros, and we're at 1.9. So it's basically 2 in terms of dollars. The average has been 1.1, and I'll end with this. The key thing that was significant is at the end, the financial crisis low was 0.46 was that bottom. That's just the problem. All you need is a trigger for a little reversion, and maybe you're finally starting. That's why I tilt over to good old treasuries. The yields are just starting to turn downward.
So with the yields going down though versus prior when they would go down and the markets would rally, is it fair to say that the markets were expecting a soft landing and so essentially no recession, and so lower rates was great and cutting rates because you weren't going to have a recession, but now the markets are starting to worry, uh-oh, here comes the recession, right?
Yeah. Well, we got the soft landing. Right. Thank you very much. It's done. Now it's time for a recession. I mean, basically, just following the example of Canada's pretty serious. There's a lot of serious situations in Europe, and China's basically, if you look at their bond yields, is heading towards a severe depression. So how's the U.S. going to stay out of it? I mean, we have our fiscal spending that's been great, 6 to 7% of GDP. That's keeping us buoyant. But you look at unemployment, something we've talked about in the program a lot. It's probably going to kick into some world tomorrow, 4.1, 4.2%. And the bottom was 3.4. It's never bottomed from that level without going to 6%. So I think what's happening is we're nearing the inflection point where markets sentiment starting to shift, that you can't just have this massive wealth effect on the Fed easing and the Fed's going to save you. We're due for some normal reversion, and I think it's just starting to kick in. Bond yields are picking up on that. The Fed is, in this case, has to stay. I think they're right on top, but they can't really do much because inflation is still sticky. But it'll drop fast when the stock market goes down, and that's the key problem. Is when you get debt to and stock market market cap to GDP this high, it's the only thing that matters on 1 to scale 10 when it comes to inflation. When that goes down, all that wealth effect is going to start coming back, and we'll get that deflation that you were really seeing happening in commodities, most notably industrial metals.
Gotcha. All right. So I think when I'm looking at this, and I'm looking at the S&P 500, the Nasdaq right now, just absolutely getting annihilated here. Semiconductors, I mean, Nvidia. Yeah. By the way, and Scott, I'd love your kind of thoughts on this. But like, how abnormal are we in this market environment where Nvidia was at $100, it goes to $121 in 24 hours? That's a 21% increase on an almost $3 trillion market cap. Now it's down. What is it, down 9% today on the day? That's not even including the pre-market highs. I mean, what is this, just like irrational investorness, or what the heck's going on?
It's really hard to explain, but I think if you bring up my screen, you can at least see what's happening, which is that in 2 weeks, 3 weeks, I guess this is 2 weeks ago, but in the third week here, this is VIX, this is our volatility index, which has been low, low, low. We went from 10.5 to almost 20 today, right? So obviously, people are feeling a little less secure. 10-year yields dropping under 4% for the first time in ages. TLT rocking. I mean, we had gold up yesterday, but even gold down today, right? The only thing that's really up, got to make Mike smile, is TLT, right? Because we've been talking about that for a long time. But yeah, I think we're in that point now where we had the rotation, right? Nvidia dropped, it rotated into other big tech. They made new all-time highs. Everyone said the tech trade's over, rotated into the Russell, right? IWM, which is even higher risk on, had that raging market there. But now that's down, everything down. This is one of the first days I can say where it seems like people are taking money out of the market as opposed to rotating. Now, it's just a day. It's just a day. So I am not going to make any wild predictions or assumptions based on that. But the money's got to be going somewhere, and it feels like it's going right into cash today.
Cash and bonds. Yeah.
Yeah, and I think you're right about that, because we definitely saw those rotations. It used to be, in fact, just the other day, we saw money rotating just before yesterday's semiconductor rally. We saw money rotating out of semis into financials, and then we've seen the Russell, like you said, and we've seen other things. But yeah, today, and what's interesting here is you guys were just mentioning before we went live that the VIX average long term is 19, and where are we now? So we're actually, it's almost like normalizing where people actually do want to pull. Yeah, it's normalizing on the VIX, which is fear.
Gareth, how are you like you have a lot of charts pulled up. I mean, how are you viewing all of this right now?
Oh man, so yeah, it's really remarkable how the charts are kind of guiding us here, and I'll just show my charts here of what we have. But really, when we're looking at Nvidia, look at this longer term trend line that it hit 2 days ago, and then we had the bounce yesterday. And again, just amazing how you go back to the beginning of the year. And so we were due for a bounce on the semis. I don't necessarily think that I expected such a fast reversal in the semis. But the other thing to note here is if we go to the S&P 500, we're basically borderline breaking down. Look at this trend line. We break this and really close below, it opens the door to a big decline, probably to this high around on the SPY about 523. And so again, for a market that's been in an uptrend where people feel like they can't lose, we certainly are now starting to see that fear creep up, like you said. And again, some of the ETFs that people track, here's the VXX, which tracks the VIX. Everyone can buy this, but remember, it's not a long-term investment; it's short-term only. But you can see, look at that pop today, up 10% on the VIX as we're seeing this come in. And you're right, I was looking at TLT before. Look at that move on TLT, which again just mirrors the 10-year. And I love showing this chart because the 10-year really follows the technicals perfectly. Here was a classic wedge pattern, right? And so you had the chart just kind of chopping to the high end, to the low end, etc. And then look at how we broke, and this is so common. We broke to the downside, retraced and retested, and then boom, to the downside it goes, and it just really collapsed to sharply to the downside too. As Powell came out yesterday, I think we'd all agree he basically laid it up for a rate cut in September. I mean, there's really, at this point, I don't think there's any doubt in anyone's mind that we're not going to get that rate cut in September, and thus the markets are reacting. And I think you're starting to see people being more worried about China, like Mike mentioned, right? China's in deep trouble. All the stimulus they've done is not working. You look at other countries around us, things are going on. The only thing that I found fascinating was that, and you guys, I'd love your input, maybe Mike, on this, is that, last night I tweeted out that Japan was threatening more rate hikes. When was the last time in history the Japanese central bank was the most hawkish central bank out there?
Yeah, there you go. The times have changed. We got that yen from what it was 164 or so back down to 150. And this was just kind of complementing that chart you showed about the S&P 500. To me, this is classic, simple mean reversion. The S&P 500 total return this high, the peak was around 24% this year. Total return so far this year is still 14%, gold's 18% on a 1 year, even 2 year basis. Gold's beating the rocks, beating stocks. And to me, this is just getting started. And that was the chart you showed it on the VIX. This VIX chart here, it's just starting to turn up. There's so much room here. And that's the key thing I think that's happening is Bitcoin's been a great leading indicator for this. And when it started doing this and stocks are going up, it's telling you that this is just early days. So what's going to save it? I don't know, but I think here I'll make a prediction for the next few years. I think some of the best performing assets will be risk off treasuries, probably long bonds, catching up to I think the U.S. Treasury at 10-year right now at 398. It's going to go to where China is at 213. And gold should do better, and we're just going to get a normal correction and everything. And remember, what led all this since 2009 and 11 was Bitcoin. Bitcoin's leading the other way. It's just overdue. I mean, some of us have seen this before, have traded it before, and to me, this might be one of the best normal mean reversion periods in our life. And I really see it happening in commodities, and that's where that chart I wanted to show you which one was. I'll show you this one here. Something you probably haven't seen before. If you just take gold divided by industrial metals index, it's popping above the level that peaked at the great financial crisis. It's only had one period it was above that when we had the biggest money pump in history around COVID. It's taking off. It's just, I love to show some of those charts that are not widely watched. That's a very significant indication of global recession from commodities, and there's a good reason for it. I mean, just here's a good fuel, and that's just plunging bond yields in China.
So, quick question on this is what we're seeing is you're talking about how Bitcoin is leading to the downside. So, are you expecting Bitcoin to go a lot lower here? Right now, I think we're trading at 63,000. Like what's your kind of downside thought process? Are we going to 50? Are we going to 40, 30? I mean, where?
Probably back to where we were before the launch of ETFs. We'll probably stop out a lot of those aggressive buying. It's just how markets work. Those of us who've lost our hair doing it. And let's just say if we get a normal, let's put it this way. If S&P 500 just fills the gap in the E-minis, which it's never left on a weekly basis since trading in 1997. When I was at a hedge fund, we based everything off the E-minis as beta down to 46. That's still another 10%. What does that mean for Bitcoin? Probably 30%. So 40,000. I don't know at the moment. To me, it's just one of those things. This is great tactical opportunities when the people who get way too long, aggressively long, they always get way too leveraged long, start getting stopped out. And one key place that's really happening is copper. Copper popped to 5 and made a all new high. Now it's below its 200-day moving average. It's probably going to go back to 3. It's way markets work. And to me, this is just the macro kicking in. What's going to save it? I don't know, but it's just normal reversion at this stage. And then we have this obviously election coming up, and it's not guaranteed that Mr. Trump will be elected. In fact, his interview last night with the black journalist is showing that he's potentially have a problem. And I think this is just a catalyst for a normal reversion, a normal pendulum swing backwards. And Bitcoin is the best leading indicator of risk assets on the planet. Now, that's the key thing I've been waiting for. Is people tell me it's going to outperform stock market when it goes up. When it goes down, I'm like, yeah, well, show me the beef. It still trades 3 times the volatility. And even gold is, people point out, went down in 2008 initially, but right now it's showing classic signs of what happens in mean reverting markets with risk assets.
You're making faces, Scott. Jump in.
I can't help it. We're talking about a 50 vol asset. So obviously you have large swings in every direction. Just draw the horizontal line from price today. And we were there in February, we were there in March, we were there in April, we were there all of May. I mean, if it's a leading indicator, it means that everybody's about to lose their minds out of absolute boredom for 5 months in the stock market, if that's what it's a leading indicator of, because that's what we have here. We were literally 4% off the all-time high 4 days ago, 3 days ago.
Yeah.
Right. So yes, we have this sell-off, but like 3 days ago, if you're sitting at 70, almost 71,000, 70,000 Bitcoin, you're like, wow, this thing is performing exceptionally well, holding near the highs. I don't know. On a day-to-day basis, it can lead, but we've been going down for days. As you said, yesterday was the best day for stocks. We had a huge down day in Bitcoin. I really think that Bitcoin, and you look at the correlation numbers, I mean, it's as uncorrelated as it's been in years. Supposed to be digital gold, doesn't correlate to that. Supposed to be a risk stock, doesn't correlate to. I don't know. I just don't see it.
I agree. And one thing that I find fascinating is that, so this is the chart of Meta, right? And Meta, it's bouncing today on earnings, but the all-time high on Meta was put in on July 5th, right? July 5th. And if we go to Bitcoin, when was the recent low? July 5th. And so what I found fascinating, and listen, it's not behaving that way today, but it's a lot of these mega caps, when they made their all-time high and have started to pull back, that's when Bitcoin caught a bid here.
See that.
But yeah, so it's just fascinating to see that. But then at the same time, today we're seeing everything sell off and Bitcoin's coming down. So it seems like I'm kind of with you guys. Like I don't fully understand what it does. It doesn't seem to have any specific direct correlation. I mean, I think it sometimes is, sometimes isn't. But yeah, it's interesting to think. So you're not thinking it goes back to 50 or 40, Scott, or you think it could still go back to 50 or 40?
50 or 40 is deeper than I would expect into the 50s. Would not surprise me. I mean, pull Fibonacci's, even just this move up, right, from 53,485 to about 70,000, as I said. I mean, we're still only at 38.2. Like a pullback to the 58, 59 would be a totally normal, pullback after that move up. But really, man, I want to see what happens in the fall, because this has my base case expectation, taking all other things out of it. And I've said it literally on this show and everywhere else since March, was that was the top. And it's about to be a long, boring, and choppy 6 months. I mean, we're April, May, June. We're 4 months into that. So we had the absolute meme coin insanity in March, where people were sending $30 million in 10 minutes to anonymous people on the internet and getting rug pulled. Now, we just had all the possible froth in crypto. Now, this could be distribution. We could go way down. I have no idea. If we did, I'd be looking for kind of this 52 area, off this sort of cluster here. Below that, I would start to definitely, get a bit more concerned. But I mean, can we speak fundamentally? Like, what outside of whatever, if we believe it's correlated in a leading indicator, but if we dismiss that as the key narrative, if we just look at Bitcoin more in a vacuum, that's an uncorrelated asset like I look at it, I mean, we've never in history had the kind of tailwinds that we do right now. So, politically, things look good. Regulatory, things look better. Legislatively, things look better. Central banks, I mean, it's just crazy.
That's when markets make peaks. And that's one thing I've enjoyed partying about Bitcoin, is you've kept me on your show despite all this. I appreciate that, Scott.
And you like Bitcoin.
Well, I did. And it's when everybody hated it and all those things look great, but now my sense it's in the mainstream. So I got to show you 2 charts about Bitcoin based on what we just spoke about. First, here's the 200-day moving average of Bitcoin and the 200-day moving average of S&P 500. Tell me those aren't correlated, right? That's all simple. It's a lesson I learned in trading pits. Does it show good chart? And you can put as many quant systems as you want. They're both completely on the same track, 200-day moving averages. And then I look at this simple chart. Here's a 100-week moving average. Bitcoin divided by its 100-week moving average, and S&P 500 divided by its 100-week moving average. I just look at this as, okay, as a trader, I'm looking to sell rallies here, and there's a lot of room downside. Fundamentally, everybody, that's the key point, is I enjoy this, is you point out some of those long-term fundamentals when Bitcoin looks cheap, like it did here. I mean, we knew how cheap it got down here. It stopped out a lot of people. As you mentioned, Scott, you went to some conferences, no one there. No one was there. Now it's the opposite. That's when you have to look ahead to things like TLT. It's one thing
man,
I really.
I'm well hedged in TLT since '84, towards the beginning of when we started this show, and I ain't never sold it. So I at least I've got that.
That's the key thing is the sentiment I got out of this latest Bitcoin conference on your show and from people I'm hearing was frothy. My classic same is not a frothy. When I think of all the smart money people I used to deal with and work with as clients and worth, they see that and they say right away, all right, find me a put strategy, because that's classic frost sign. It's just a question of where does it stop? And that's why I point out the big factor here is volatility on beta is so low and interest rates are so high, and they're just starting to roll over. The bottom line is when you're running money, you just stay away from the risk assets. Bitcoin's one of the riskiest, and you focus on things that will make you money when those risk assets revert. And this is all this is right now. It's just reversion. The question is how far it goes.
So speaking of reversion, are we going to see any reversion in gold back down towards 2,000? Or you think at this point it's headed north over 25,000? What are your thoughts on that?
Bottom line is, I think it's just a matter of time it gets to 3,000, but it's always the way it works is, when you hit stops in beta goes down a lot. You sell what you can, not what you want to. And when the number one thing is there's a lot of profits in Bitcoin, tons. I mean, the most ever. What's significant about gold is ETF holdings have just started to turn back upward. The biggest turn I've seen since the bottom in 2016. So we know the biggest. The deepest pockets on the planet are buying gold, starting with the war. It's China, Russia, and everything are buying gold. They're maybe lightning stop curtailing their buying. Futures are pretty long, but those ETFs are just starting to turn upward. And that's where I see gold's going to pull back if stocks go down, but it's the shift. It's the transition. And the bottom line is here, I'll end with this. On a year-to-date basis, gold's up 18%, S&P 500 is 15%. On a one-year basis, gold's up 25%, S&P 500 is 21%. On a two-year basis, gold's up 38%, S&P 500 is 37%. And those are total returns. It's so out of favor in terms of ETFs, it's just starting to come back. And that's why I look at what's really out of favor is been bonds and gold. And what's been really in favor the most in the history is stocks. I think that's just reverting a little bit.
Are you equally as bullish on silver, palladium, and platinum, or the industrial side kills them?
No. Yeah, that's exactly. The devil's metal, you just look at copper, it's breaking down hard. Platinum I'm pretty bullish on. Palladium is very much industrial and it's been replaced because of EVs. Silver, the devil's metal for a reason. And the problem with silver, I still think, is it's more like copper now than it is gold. It does have a beta to gold, but like today it's down 2%. I mean, it'll hang in there, probably should do better than beta, but it's an industrial metal.
Gotcha. All right, guys, we have a couple minutes left. So I'm getting from you guys TLT. I think that's been a consistent theme on this show. That's been a great performer. Gold, iffy. Bitcoin, a little Bitcoin, but Mike's against it. I think Scott, you're still in the camp that at some point this boring action eventually leads to all-time
right now
highs.
is an opportunity. Mike would say run. So I think we're kind of on the opposite.
I like that. I like when not everyone agrees.
We make a good market, right?
Yeah,
exactly.
You literally have to have someone to buy and someone to sell, so it shouldn't be that surprising.
And then, are you guys both like anti being in stocks? I mean, I'm not talking long-term investing. I'm talking about shorter term over the next 3 months or so.
There's nothing that screams buy to me unless you're like aggressively trading, and I'm not. So I'm just kind of.
And just one quick pushback on that is, everyone's been like, hey, this is going to be the greatest bull run in the stock market because the Fed's going to start cutting rates. But clearly, at least as of now, we're not seeing that. Do we see anything like that?
I had a question. Bring up my chart because I have my screen. Because actually, I wanted to ask Mike. Yeah, we're as close now to the yield curve finally normalizing as we've been in 2 years, which is the longest that we've had the yield curve uninverted. So actually, I wanted to say that because we've showed this before, but I want Mike's opinion. This is the Fed pauses, guys. This is a Fed funds rate is in red. The stock market's in black. It's literally off the chart, and you can't get it back on. That's how high it is. And blue is the yield curve. You always, as we've talked about, you get the pause, then the market, then you get the yield curve, uninverting with the pause, and then a little dip maybe in stocks. Like it starts to dip here, and then falls off a cliff when they pivot. So it's starting to smell like that could not be an unlikely scenario.
So how far are you going back in that chart? Let's look almost 20 years.
This is back to 99. So yeah,
so exactly. So this is what I am.
Time now.
And to me, this is I have to admit, I'm making the call of a lifetime, and something I've been wanting to put paper on for a while is throw out the models and focus on the history books, which I've been doing a lot. Everything points to normal reversion. What you're seeing is just the beginning of almost the longest period in history of inverted yield curve. And when you give up on it, which was perfect, when markets rally and give up on it, it's a tremendous opportunity for those more tactically orientated. And to me, that's where we're starting now. We're just starting to flip over to the tactically orientated, making a killing. The hedge funds who are going to come, we're going to find out later, those who were able to buy some of the Bitcoin on the way up, getting out of risk assets and focusing on things you can make up. One of the key things I've noticed is leveraged treasuries. Treasuries are the most leveraged market on the planet. And let's look at Martin's Wide. How did he make a killing calling the crash in 1987? He was long treasury bonds. That trade, I think, is revisiting, and it's just a little bit of normal reversion. But remember, it's on the back of historic events. You have to go back 100 years. I mean, Bitcoin never existed until 15 years ago, and so I look at it as leading indicator. I really prefer when people push back on that, because when everybody agrees, I'm usually wrong.
Gotcha. All right. On that note, folks, our time is up today for Market Mavericks, but I think we'll be back next Thursday. Thank you all for tuning in. And guys, make sure you follow these gentlemen. Their socials are at the bottom of the screen, and we'll see you all next week. Take care.
Thanks, boys.